This is the Financial Thought Exchange podcast brought to you by the CFA Institute Research Foundation. This is where you get a little wiser by learning from the leading thinkers in finance. I'm your host, Lotta Moberg, and our guests today are Thomas Idzorek, Chief Investment Officer of Retirement for Morningstar Investment Management, and Paul Kaplan, now retired, but formerly Director of Research for Morningstar Canada. Now, the piece you see on the screen for those you watching a video here is their book that they published with us, with the Research Foundation. It's called Lifetime Financial Advice, a personalized, optimal, multi-level approach. Thank you, gentlemen, so much both for being here and for spending all this time writing this excellent piece for us.
Thanks for having us back.
So this is actually our last conversation, and we realized that we could talk about this forever, but everything that is wonderful has an end as well. And before I jump into all the questions that I have that I'm hoping that our listeners are also curious about knowing this piece, maybe Thomas, you can guide us through giving us an overview of where we are in this conversation, or really how people should think about this piece as they are going to read it, and where it is going, and just high level constructions that we're not getting too lost in between the trees here, so to speak.
Sure, I'll try to do that. My recollection is that we're kind of halfway through part one of the book, and the book is organized into 3 parts. So I think we're going to try to speed up here and hit the highlights. I think there'll be a little bit to talk about in part one, which is, again, our life cycle model, which is the economic approach to financial planning. And this really provides answers to the strategic questions that people have: how much to save, how much to consume, how much to invest, with the goal of trying to smooth lifetime real consumption. That first model, that kind of macro model, that top level model, provides a wonderful view of what somebody's total economic balance sheet looks like. And again, from Paul and my perspective, that balance sheet is the best indicator of somebody's kind of true financial health. And that's reflected in ultimately their net worth, which is assets minus liabilities equals net worth, where the liabilities are the non-discretionary consumption that an individual has as kind of a goal. And I recognize that's not a legal liability; those are soft liabilities. And then based on the composition of that balance sheet, it provides inputs into our child model, which we refer to as a net worth optimization. And kind of that's part 2 of the book. And I believe there's a number of firsts there. Big picture, net worth optimization is an extension of Harry Markowitz's mean variance optimization approach, which I might describe as long only or asset only, in which we are building off of the surplus or liability relative framework by including the investor's non-discretionary liability as a combination of asset classes kind of held short, representing the systematic cash flow characteristics of that liability. And then something that's kind of new and unique in that net worth optimization is that we're also modeling what is arguably the most important asset of the individual, their human capital, held as an untradeable asset, held long. And so in light of their human capital, their non-discretionary liability, that net worth optimization is determining for their financial assets what is the most appropriate asset allocation. And then something that, again, I think is new and innovative is that we are splitting in a single optimization that financial asset or target asset allocation into actually 2 or possibly 3 targets for each kind of bucket of money that somebody has. So a target for their taxable money, a target for their tax deferred money, and a target for their tax exempt money. And again, where all of those kind of key elements of human capital and the liability are coming from the life cycle model, feeding into that part 2 child model. Then that part 2 child model takes those target asset allocations and feeds that into part 3 of the book, which is where the rubber really meets the road. And in a form of an extended alpha tracking error optimizer, we are able to optimize simultaneously across all of the accounts that an investor might have. So their 401k, their IRA, their taxable accounts, maybe they have a Roth. And in light of all of the investments that might be available in all of those different kind of accounts or account platforms, the final optimization is able to determine what they should be buying and selling in each one of their accounts, all with an eye towards tax efficiency. So sorry for a long-winded answer.
No, that's excellent. Well, since you touched on it now, then because the tax part of this, I think that could be one question. I thought about a few questions that people will be asking about here. They'll, in terms of what might be missing, what we've covered. How about uncertainty? How can we know that you can, just because you think you're going to invest in a certain way, this is actually what's going to happen? The other one would be taxes. So we can hit on that. We might hit on the non-pecuniary, that is personal preferences that are not the money part as well. And also we want to talk about how we're actually implementing this model ultimately. So in terms of just taxes, maybe either of you can dig in a little bit, give a little bit more detail about how we deal with taxes, because as you lay out, there are three different kind of types of account. You can think of a non-taxable, a taxable, a tax deferred, and how can you possibly then put these? Do they become three separate islands of models, or how do you combine them in the framework?
And I'm going to punt this over to Paul in just a second, but in general, what we're talking about, at least within the net worth optimization, is something that is referred to as asset location. So how do you locate, or at least locate the targets in the appropriate account type? And again, Paul did some very neat work on this back, I'd say in the 1990s, in terms of how do you determine, I'd say, pre-tax capital market assumptions, and then how do you adjust those capital market assumptions for taxes, and then ultimately determine a tax efficient target inside of, say, a tax deferred account or a taxable account. So, Paul?
Yeah, the way we model taxes within an optimization framework is we create, for each asset class, we create what we call an effective tax rate. So the idea is that if you apply that tax rate to returns on that asset class, that gives you what your after-tax return is. And there's a few different factors that go into the calculation of the effective tax rates. One, how does in the asset class, how is capital gains versus income return? And then another factor is within the capital gains, long-term versus short-term capital gains, within income, qualified versus non-qualified income, and finally turnover. So we've developed a set of formulas to take all these factors into account and come up with an effective tax rate. What we have the optimizer do is look at everything from an after-tax perspective. So any asset classes that are held within a taxable account, the effective tax rates are applied to those returns, and any assets that are held in a tax advantage account, then we do not apply effective tax rates to those, and we basically tell the optimizer, how much of the overall portfolio is in taxable assets, how much is in tax advantaged assets, and basically taking all of these capital market assumptions, expected returns, standard deviations, and correlations, as is done in standard mean variance optimization. We also take into account the effective tax rates, so that our solution not only gives it an asset allocation, it also gives an asset location, how much of each asset class is held in which type of account.
So it would be good to understand just the connection between you're deriving both the returns for the non-taxable and tax returns, the tax and non-tax returns, and the standard deviation. So what's the connection between that? Like why is that a necessary step to include?
Because taxes affect returns via multiplication. So basically, if I start with a pre-tax return and I multiply it by 1 minus its effective tax rate, that gives me the after-tax return. That means its expected return is 1 minus the effective tax rate times expected return, but it also means that the standard deviation on an after-tax basis is also 1 minus the effective tax rate times the standard deviation of the underlying asset class.
It's a lot of, as you probably recall, in kind of the Markowitz model of mean variance optimization, there's generally 3 sets of inputs for each asset class that is getting considered. There's the expected return, there's the standard deviation, and the correlation, and that is essentially the 3 inputs for mean variance optimization. And I think one way to think of the net worth optimization when it's been expanded to simultaneously solve for the policy portfolio for your taxable assets as well as your qualified assets, it's almost as if there are 2 sets of CMAs at work that the optimizer is contemplating. And there's slightly different ways one can set that up, but conceptually, it is understanding, the optimizer's understanding what is the actual tax efficiency based on your assumptions of each asset class. And then what it will tend to do is say, here's what your overall policy portfolio should look like when I combine qualified and unqualified policy portfolios weighted by your after-tax dollars. But then I can split those out in such a way that we are, again, locating tax inefficient assets in your qualified accounts in the more efficient asset classes in your taxable accounts. And so maybe as a heuristic for kind of people that won't be able to build this type of optimizer is, it shakes out generally like kind of most guidance that you hear is where you're taking often fixed income and you're locating that in your qualified accounts, and then maybe large cap U.S. equity oriented items probably fulfilled, using an ETF are going to be located in your taxable accounts.
Yeah, no, that's great. So for our listeners who remember that there are several components in terms of thinking about what's the best portfolio of a person, even before we get to this complicated topic of taxes, when we do get to the tax and doing everything that we've been explaining now, are you still accounting for these factors that we talked about early on, which is like the consumption preferences, such as consumption smoothing and things like that? Are they still included in the model?
They are included in the model. They are what we call the parent model, which part 1 of the book describes in detail. So we first do a life cycle analysis to come up with things like, discretionary consumption and how much the person should save each year, and how much they're going to consume and so on. Then the results of that then become the inputs to the net worth optimization, which we're just describing now, which is covered in part 2 of the book.
And Lotta,
one feeds to the other.
Sorry, Paul, I didn't mean to interrupt. I guess I feel like we're developing what I would say is kind of a new class of model, a combined model. So a mystery from my perspective is that, around 75 years ago or more, you had the kind of the invention of life cycle models. And again, economists generally agree that this is the best way, the most powerful type of model for financial planning purposes. And life cycle models involve optimization. And then again, it was also in the 1950s that Markowitz developed mean variance optimization. And of course, most practitioners, I think, are arguably familiar with mean variance optimization, but probably not familiar with the life cycle model. So in my mind, there's a number of firsts in the book, and again, hoping people will be interested enough to read. But one is we're able to really, in a meaningful way, for the first time, in my opinion, bring these 2 forms of optimization, both which, ended up leading to Nobel prizes for the various kind of luminaries that did this early work. where the life cycle model, the parent model, is running and then producing essentially the inputs that are feeding into that mean variance type optimization of model, which again, we've expanded to be a net worth optimization. So that interaction, that handoff of output from the life cycle model as inputs into the part 2 model, the net worth optimization, again, from my perspective, is a real first.
Yeah, no, that's excellent. So when it comes to the taxes, how we handle that, just to latch on a little bit more on that, you do note that because people actually do have different marginal tax rate, there's no one marginal tax rate, and marginal is, of course, we know what matters for people's actions. This exercise of asset allocation at the after-tax optimization should be personalized. I'm wondering about that. How do practitioners go about doing that to personalize the inputs here of the marginal tax rate?
I think they would have to basically go to their tax filing each year and see what is their marginal tax bracket that they're in, and then that's what we go in the model.
Yeah, no, that makes sense.
But Lotta, in general, relative to what's in the marketplace today, the most common practice is, the home office or an advisor is using a set of models that is generic for, say, taxable accounts, and another non-personalized generic set of models for qualified accounts. And so to me, one of the improvements that we're making is that, in light of that individual's personal situation, running the life cycle model and having those inputs that are, again, now specific to the individual feed into the net worth optimization to really arrive at which asset classes should be located where.
Yeah, no, that makes sense. So how about the trading cost aspect then? If we're talking about different accounts, we are thinking about moving money between those accounts, and there'll be trading costs of doing that. You realize that, oh, well, the tax situation is more favorable in this account with this specific asset. How do you include in that consideration in your framework?
That really moves us kind of from part 2, the part 2 model, the net worth model that I've just been describing, into part 3 of the book, which is kind of our multi-account alpha tracking error optimization framework. And again, so to try to set that up, so now, again, big picture, the net worth or the life cycle model has been run. It's created, views of the individual balance sheet. The outputs from that model feed into the net worth optimization. The net worth optimization now produces target asset allocations or locations for taxable and tax deferred money that then feed into the final optimizer, which is the basis of part 3 of the book. And again, so for every investment that is available in each account, again, one needs to come up with, an alpha, an expected after fee alpha. And if it's in a taxable account, it is an after tax expected alpha for the fund. And then every trading cost that one would experience, like, so in your 401k, as an example, there may be no trading costs at all. You might have an account that's through an IRA that could involve, very low trading fees. There could be, a fixed dollar cost or a variable cost associated with the trade. And so the optimizer that we've, built into or put forth in part 3 of this book, requires all of these inputs, and then it can actually decide in light of the trading costs as well as, let's say, the tax implications. So some investors may have, purchased, a stock or a mutual fund or an ETF many years ago in a taxable account, as an example. And at this moment, it may be trading well above its cost basis, and thus would realize taxes at this moment in time. And in general, the optimizer is trying to avoid current taxes, and it's trying, and so if there is a giant tax implication or there are trading costs associated with trading, the optimizer is only going to recommend that the person, buy and sell various items if the end solution has overcome the cost of the trade, whether it's, an actual trading cost or the tax implication of making that trade.
Maybe it would be good to ask a high-level question as you refer to the optimizer. Who is this optimizer person, and how does that work? Is it an Excel sheet? Is it an AI bot that you're conversing with? People might be wondering about that.
Right. Well, the book is laying out the methodology or how would one go about creating the different models. And of course, one way in which the model comes to life is that in the real world, software manufacturers like the firm that I work for, creates a software system that attempts to make what we're doing in the book, easy and available and scalable to those that might want it.
Yeah, the optimizer is a computer program.
And is that Go ahead.
Yeah. In 1987, Harry Markowitz published a book in which he actually included an actual computer program that implements the optimizer.
That was the Markowitz optimizer in terms of solving his model, the frontier model that has a trade-off between returns and standard deviation.
That's right. And the optimizer we're talking about that we developed, the net worth optimizer, it's basically just an extension of Markowitz's original optimizer.
So for our readers who are going to want to implement this, is this computer program something special that is difficult to get hold of, or is it something you just have to put it in your own Excel sheet, basically using your framework?
Yeah, well, so again, I guess I don't want to be commercial.
Okay.
So the models are there in the book, and of course, people can attempt to, create them on their own. Again, I think from a practical matter, what we're, to make the book easy to use for, financial planners and financial advisors, commercial software needs to be developed. And again, of course, we work, Paul is recently retired, but, we work for a firm that develops these types of commercial models that would attempt to take all the complicated math and make it easy for people to, help manage, their clients' money using these types of models. With that said, again, the types of, a lot of times, people are solving, quadratic programming, problems. There's many algorithms for solving those types of problems. Again, one can set that up in kind of the environment of their choice these days, whether they're using, Python or R or MATLAB or Excel, as you've mentioned. Modelers have a wide variety of, if the do-it-yourself modeler, I would say, can kind of go to town. And again, one of our hopes for the book is actually, we've put forth, again, what I would describe as a new class of model that is combining essentially, it's the three-part model of life cycle model, net worth optimization, and extended alpha tracking error optimization. Our hope would be is that other researchers will say, okay, this really does usher in a new class of model that is taking life cycle models combined with single period optimization models, which is a new way of really creating great outcomes for end investors. And again, like I say, I believe Paul and I are kind of the first to make that actionable and somewhat practical, although it does require commercial software. But hopefully other researchers will say, oh, now that I see how to combine a life cycle model with a single period type optimization model, they'll say, we too can advance the state of the art on behalf of investors for better outcomes.
Yeah, no, that's excellent. Yeah. So if people want to learn more about that, they can reach out to you guys, right?
Absolutely.
So I want to touch upon then the topic of uncertainty. So whenever you think about an optimizer, you think about, we have very precise data, of course, that we have to have data very, very precise. Always going to be a number, and you get a very precise outcome. So how do you deal then with uncertainty in models? Specifically, you on the technical level, if we start there, you talk about it from the context of implementing what's called a social discount factor. Maybe you can explain to people what does that do for us and what it is, that social discount factor.
Yeah,
if you don't mind,
it's not the social discount factor.
Right.
It's the Yeah.
Go ahead.
It's the stochastic discount factor.
Okay.
Is what it's called.
Oh, I said it wrong. Okay.
Okay.
And so, real quick though, Paul,
anyway,
do you mind if I, to set it up? So, uncertainty, right, is prevalent in all three phases of the model, and it manifests itself a little bit different way, so there's uncertainty modeled through the stochastic discount factor entering into the life cycle model. Then in the net worth optimization, we're kind of in uncertainty is typically represented by standard deviation or variance, and this is now, specified in kind of net worth space. And then as you move into the alpha tracking error optimization, uncertainty is really defined as tracking error. So it permeates throughout the three stages of the model. The one that is most unique or probably new for many people that don't have a PhD in finance is kind of that pricing kernel, that stochastic discount factor. And maybe, Paul, I'll punt it back to you to elaborate just a bit on that.
Well, sure. The idea of the stochastic discount factor, or the pricing kernel, as it's sometimes called, I was first exposed to it in the first part of the 1980s as a PhD student at Northwestern. So, this is an idea that's been around for a long time. It's very well established in the academic financial literature. We introduced the concept in a very simple way in chapter 3 of the book, where what we say is the idea is that let's suppose there are only two possible future states of the world. We'll just call them up market and down market. Then in that case, what would you like to hold in your portfolio? What would you like to invest in? Well, you want to come up with some combination of investments that pays you something in the up market and pays you something in the down market. So, for example, let's suppose in the up market, there's a security that pays $3, and the down market it pays $2. So, kind of something that kind of moves up and down with the market. Now, the idea of the stochastic discount factor is that that in a complete market in which it is possible to basically purchase contracts that are dependent on the value of whatever the state of the future is. And so in this example, what the stochastic discount factor tells you is how much would I have to pay today in order to get paid $1 in up markets and nothing in down market, and how much would I have to pay to get $1 in the down market and nothing in the up market? Because if I could do that, if there's a price for every possible future state of the world, then you can price any security or any work out what any portfolio is supposed to do. So that's the basic concept, and we introduce the concept again in chapter 6 in a much more general way, where we make assumptions about what is this stochastic discount factor, what kind of values it might take on in a variety of different states of the world, and that way we can put a price on every security, and therefore we can allocate our assets, and we can build our portfolios on the basis of this. So the way we're modeling uncertainty is, number one, we're assuming that there is uncertainty about the future. But to keep things simple, we're going to assume that we know what all those possible future states are. Number two, we assume that that we have a complete market, so there's a market-determined price for the delivery of $1 in every possible future state, and therefore we can price any security and therefore value any portfolio at its market value. So that's one side of it. The other side of it is from the investor's point of view. The investor has the investor has an attitude towards risk, which is called risk tolerance, and it's basically what the investor's risk tolerance is versus what the market is offering and what are the possible states of future states of the world that together determine how the investor is going to invest.
Great. So this the stochastic discount factor, it's an objective factor. It basically tells you how much the market is discounting what is, let's say the expectation is that the S&P is going to go up 10%. But because that's an uncertain outcome, the assets representing that outcome is actually going to be worth less than that kind of expected, because there's a discount because of that uncertainty.
Yeah, each state of the world, there's going to be a discount factor implied by that. In some cases, it be less than one as a discount factor. Sometimes it might be greater than one in certain states. But overall, what it's going to allow me to do is to say, how is the market pricing? Let's say, like you said, like the S&P 500. What's the market price of a portfolio of those securities that's going to make future payments in the future. But we don't know which state's going to occur in the future, so we have to price every possible state.
Right, and the bottom line is it's an objective. It's not a subjective discount factor, such as for me, because I have more risk aversion or something like that, I would discount this more. It's something that you can observe, that you can therefore say this is for the market as a whole, that this discount factor applies at this moment in time.
Well, in theory, yeah. I mean, first of all, yes, it is objective. It's not related to the investor. However, how observable it is a whole nother question, because in reality, we don't actually have markets that pay $1 in this state, $1 in that state. So there has been sort of some academic research. There has been academic research on sort of trying to kind of discern what that stochastic discount factor might look like, but it's a theoretical construct. It's not something you just go out and observe.
But I guess I view this as kind of a nuance or a detail of the model if you want to build such a model. But if you're a user of the model, you may not care about some of the details. But again, going back to kind of the idea of a balance sheet, so assets minus liabilities equals somebody's net worth. The reality is, their assets and their financial assets might increase in value kind of during some kind of random oriented paths. The value or the cost of consumption that, is random and could, vary. How much does somebody earn via their human capital, and how much is their human capital really worth? That is going to vary. And so, your net worth is almost, kind of it's random and dependent on kind of the randomness of all of the other pieces of your balance sheet that are moving around. And, because we're able to, model this uncertainty, this randomness, you're able to have a whole distribution of what does somebody's economic balance sheet look like now, and what might it look like in the future. It could improve in strength, or it could weaken in strength. So sometimes I kind of think of as, the life cycle of model. Again, I said earlier that it's the most advanced kind of form of financial planning, but I sometimes think of it as kind of like an AI-oriented big blue master chess player, which is it's thinking about every possible state of the world. And then in light of whatever ends up happening, whatever that future state of the world would be, is what would the optimal decision be on behalf of that investor that one is trying to help.
Great. And the magnitude of the stochastic discount factor does depend, I believe you mentioned, on real economic factors. So would that be geopolitical factors, such as Russia launches a war in Ukraine? You would expect the discount factor to increase, or for that matter, an economic recession expected to be imminent?
Yeah, I mean, so it is going to be related to kind of the overall state of the economy, because because basically, what is the value of a dollar? What is the value of a dollar when let's say things are going really, really well? Then the value, the value of an additional dollar is not that much. But when things are really bad, like you're in a deep recession or something, then the value of a dollar in that state is much more. So it is tied to the state of the economy.
Gotcha. And how this is implemented then in the framework, is that such that a person investing, if it seems like this is an environment where there's a lot of uncertainty, and therefore the stochastic discount factor should be higher, and we should thus expect different returns and therefore adjust our portfolio accordingly based on those forward-looking forecasts, so to speak, or expectations.
Well, what we actually do is we make a basic assumption regarding it, and then we use Monte Carlo simulation. So what we're doing is we're simulating a whole series of possible futures, and in sometimes that future is not so good, and sometimes that future is better. But there's a whole range of possible values for it. So we're not saying that it has this value right now, therefore the investor should do such and such. Rather, what we're doing is we're using it to see what are sort of the possible paths that would be relevant to the investor. And one of the things that we do is at various points of that simulated history is that we then run the optimizer we were talking about earlier, and then we can see, in one type of, if 10 years from now, it's a very good environment, a very good economic environment, this would be this is what the asset allocation would be, or alternatively, in 10 years from now, if the economic situation was very bad, this is what we would. This is what the optimizer would tell you that the asset allocation should be. So a lot of actual practice, it's going to vary over time. As let's suppose we were running our model once a year to decide, to review your asset allocation. Well, the numbers that are going to go into that are going to be the numbers that go into human capital and liabilities, your financial assets. So everything that sort of everything that you sort of can observe about the investor, at the moment, and then we run the optimizer to see, to then come up with a recommended asset allocation.
And so from a practical perspective, let's say, you were meeting with a client, you're in a financial advisor, you're meeting with a client, maybe they're 40 years old, they're, 25 years away from their expected retirement date or target retirement date. What you would be able to do is you'd be able to say, look, here's what your current balance sheet looks like. And at the point of retirement or anywhere along retirement, here's what I think your balance sheet will look like, including your assets, your liabilities, and your net worth. And then let's say that things go, better than expected or worse than expected. You could create, like, here's what it's going to look like kind of in a good scenario, or here's what it's going to look like in a bad scenario. And so that financial advisor, that financial planner would be able to paint a picture of what that investor's future might look like and have a discussion around, here's, what we'll do under these kind of different scenarios. And of course, along the way, nobody lives in a vacuum. They're going to keep, updating I guess reality is that the investor's circumstances just keep investing as or changing as the markets move up and down.
And if you're optimizing after you run that Monte Carlo simulation, that means that you're actually optimizing for each assets in a portfolio, and then use the output that you get from there and run the optimization from there.
Right. Well,
the purpose of...
Go ahead, Paul.
Sorry. The purpose of the Monte Carlo simulation is to show the investor what the future might look like. but it doesn't impact the advice you're going to give today, because the advice we give today is going to depend upon how, what we've estimated their human capital to be, what we've estimated their liabilities to be, how much they have in financial wealth, what we've estimated their risk tolerance to be, and other parameters. How big a bequest maybe they're looking at, and all those factors which just go into the present. But having done that, we might want to then say, okay, well, let's run the clock forward and see maybe how things might change in the future, and that's where the Monte Carlo simulation comes in.
Another implementation that I believe you mentioned from the stochastic discount factor is changing the consumption behavior, kind of consumption matching to the stochastic discount factor. How would you describe that kind of exercise?
Well, it's part of the model. Because naturally, it makes sense that as this stochastic discount factor value changes over time, given your level of risk tolerance, that's going to impact your consumption, in a certain way.
Yeah, no, that makes sense. That's a good clarification, actually, and maybe also to remember that it's only one out of several things that's going to affect your consumption. Obviously, if there's personal factors in there having to do with non-discretionary expenditures coming up, and because college and such, that's going to obviously affect how we're expecting your consumption path to look. So it's one factor, but not the only, and probably not even maybe the main factor.
Right.
That seems right.
Well, it is a major factor for sure, but there are other factors that come in. A very important one, which I don't think we've mentioned yet, is longevity. How much you consume today depends also upon what's the likelihood you're going to survive into the future. And obviously, those numbers are going to be very different for older people versus younger people. And another thing that's going to impact is if you decide to use annuities, because annuities you can use to address longevity risk. Because if you don't buy annuities, you may what could happen? Maybe you spend a certain amount, and then you continue to live, and you don't have the resources anymore. Well, annuities can help you address that problem, because they provide a lifetime of income, no matter how long your life is.
Well, maybe we can get a little bit deeper into that, because you have these different spending rules that you lay out, and so maybe you can give an overview of the case. There are different cases. Like if we're thinking about spending rule, if you don't have any annuity or life insurance, and when you have annuity, but you do not have life insurance, and then also if you do have life insurance, there are different spending rules there that come into play, right? Maybe we can give an overview of that.
Yeah, so let's start with life insurance. Life insurance basically is like it's basically like a liability in that it reduces your net worth if you go to buy life insurance and guarantee a bequest. Now, like, who should buy life insurance? Life insurance should be bought by people, young people, basically young people with families, or people that want to make sure that should something happen to them unexpectedly, that they're just money left behind, and that's kind of the main function of life insurance. There's all different ways to buy life insurance, but we basically are focused really on term life insurance, where each year you buy the amount of life insurance you need in order to meet your bequest, because as you accumulate wealth, you might be able to accumulate enough to leave a bequest without life insurance. So life insurance is usually something we associate with the first part of the life cycle. And then the latter part, annuities, is something we associate with the latter part of the life cycle, where the concern is is that you might live for, relative to your assets, you might live too long. So that's where annuities can come in, and basically give you a guaranteed life income that will continue on and on as long as you continue to live.
Yeah. So do you want to say anything about the spending rule part of that? Because it has different implications how somebody consumes then over in the discretionary consumption over lifetime.
That's right. So let's suppose I don't plan on using annuities. Then the thing is, when I'm looking out into the future, and how much do I plan on spending over my lifetime? That the amount of consumption I plan to have for the really distant future may be quite low, because it's unlikely that I'm going to actually be alive. If it's very unlikely that I'm going to be alive at some advanced age, then I'm not going to plan on having a lot of consumption in the future. However, if I use annuities, it's a very different picture, because now I can guarantee life income, and I can plan on continuing to have a level of consumption on and on, no matter how long I live. So yeah, it has an effect on how you plan your consumption.
Can I attempt to add to that a little bit? So, Lotta, think about if you were 65 years old, and for somebody that's 65, your life expectancy in the United States is not quite 85, but let's call it 85. If you are going to not annuitize and you're just going to spend down your wealth, of course you as Paul mentioned, you start off and you're probably spending at a pretty good clip, but as you start to approach age 85 perhaps, and as the amount of your financial assets is starting to be drawn down, from a prudent perspective, and also from the model perspective, what happens is you begin to reduce how much you're consuming, because you're worried all of a sudden that you're going to outlive 85. If you had gone ahead at age 65 and purchased that annuity, it doesn't matter if you make it not just 20 years, but maybe you make it 40 years, all the way to 105. And you can just consume based off of that endless annuity stream that will last as long as you do. And so you're no longer worried about living too long.
Yeah, no, that makes sense. How about the types of the fixed versus the variable annuities? Which kind of investor should use what kind of annuities there?
Well, I'll put it to you in a second for
type
Paul.
does.
Go ahead.
Okay. So the immediate fixed annuity, I pay a lump sum premium now, and I get a guaranteed stream of income for life at a constant amount. However, like we were talking about uncertainty and the interaction between the uncertainty of the market as modeled by the stochastic discount factor, and risk tolerance, it makes sense that you do want to be able to consume more when let's say in up markets, and consume less in down markets. And you can achieve that with an intermediate variable annuity, IVA, where instead of the payment being a fixed amount, the payment is like a fixed number of shares on a portfolio. That so the portfolio, the underlying portfolio, consists of risky assets, and so when the portfolio does well, you get more income. When the portfolio does poorly, you get less income.
And,
Do you mind if I, chime in just to, so, it's somewhat going to be a factor of your asset allocation. And so again, we're running our net worth optimization, which is determining what should your asset allocation be for your financial assets. And for a given person, that might be nearly all bonds or it might be all equities. And whether that 65-year-old needs to, purchase something that is essentially a fixed rate oriented annuity or a variable annuity depends highly on their target asset allocation for their financial capital.
you mentioned something else about the variable ones that you should use. From what I understand, you should use variable annuities in risky markets. That might be counterintuitive because so there's the other question of it, right? On the one hand, there's individual reasons to do fixed versus variable, and then there's also maybe different market conditions. I would have thought that you want a fixed one when the markets are more volatile, so that the variable one doesn't come, too volatile of an income stream. How do we understand kind of that trade-off?
Yeah, well, the idea is that if markets are risky and there's going to be they're going to vary in value, and you don't want to have you want your level of consumption to be sensitive to what's happening in the market. That's otherwise, I mean, if you sort of have a fixed consumption in the in the face of a variable, your let's say your investments varying in value, then you have a mismatch between your consumption and your investments, and because what you don't want to happen is just to sort of keep everything fixed, regardless. Well, then why bother hold risky assets? They don't serve any purpose unless they can unless their changing value is going to affect your level of consumption.
So there's a social factor there of like, if all your friends' bonuses are going up because the markets are soaring, you don't want to be the one not joining at the lobster bar, things like that. So when we're thinking about if we're thinking about the issue of uncertainty and optimization versus really reaching a certain level, annuity is a great example of this, by the way, that you were basically saying, look, you're going to know what you're going to consume. It means that you are giving up kind of the upside of that consumption, because you could have invested it in some high-tech startup and that could have been great, but you could also lost your money. You don't have anything else to consume. But you do discuss this area of goal-based investing. So it'd be good for you to hear, just, is this a way that you recommend people think about it too? Goal-based investment is usually, I need, like, in my investment portfolio, I want to reach this certain level of assets so that I can have this kind of level of consumption. A goal-based could also be a certain point of time. I know that I'm getting married then and I need an extra cash then. Is this approach that you are implemented in your framework?
Paul, if you want to go, I'll let you go.
Okay, then you. Yeah, I mean, we no, ours comes from life cycle theory. It does not come from the goals-based ideas, which I think these goals-based approaches, they're kind of very ad hoc. It's like, because they're not looking at your overall consumption as a whole. Everything is sort of being boiled down to some number of goals, and so I would say no. We think that a holistic approach is better. That what you should focus on is your what kind of consumption can you finance, and then along the way of course you'll buy various things, but I think it could lead to also some strange results too, which is that if you say, well, I need a certain amount of money, in 10 years to buy, to make a particular purchase, and how should I invest the money today? Yeah. And then what happens what happens if, let's say, the market does poorly and the money that you've been saving up to that goal is not there? Then what do you do? Well, at least in some models, it would tell you to go really risky, in the hope that the market will turn in your favor. We don't think that's a very good approach.
Okay, so the one big negative goal-based investment that you would say is exactly that you try to reach it by all means necessary, and therefore end up with reckless kind of decisions in some cases.
Well,
yeah, at least in some cases,
right. And I think Paula and I are in the life cycle finance camp. Goals-based investing has a neat name. I think advisors are somewhat enamored with it, but again, it's it doesn't have the rich theoretical underpinnings and history that life cycle finance does. And again, with life cycle finance, the belief is that by kind of maximizing that lifetime of relatively smooth real consumption, the benefit, the joy, the utility of the investor is maximized. And as Paul was indicating, when investors may choose an unrealistic goal, and again, there are different, so there's more ad hoc, and there's variety of goals-based approaches. What ends up happening in many instances is, if you've chosen an unrealistic goal, you end up investing very aggressively, swinging for the fences, if you will, in an attempt to reach that goal. And again, at least from our perspective, that doesn't make much sense.
Yeah, that's understandable. Okay, so our viewers here, if you haven't read the piece yet, presumably you have seen our three previous conversations we've had about this piece. It's rich of a lot of content, and we are skipping a lot of things that you'll find enriching from reading it. So that is by necessity. We're not going to talk about everything today. So knowing that the people hearing our conversations have not gotten all the pieces in place, I think it's still good to dive into a little bit kind of how we think about them, how they should think about it when they read it, about implementation of the framework. And I guess I'll start with just asking you both what you think when people go through the models and think about how to implementing it will be the main challenges in implementing the framework.
It's a good question, and I don't know that I have particularly good answers. But so again, I think the book could be read by a variety of different audiences. And so like maybe if I just start with your typical financial planner, advanced financial advisor, I think there's a lot for them to take away from the book in terms of learning about life cycle finance, the overall view of integrating this model with single period models, and having the gist of what is getting proposed. Again, to actually implement what is in the book, would require probably people with PhD level skills and high level kind of programming skills. It would not be easy. So where does that really kind of leave us? For the majority of practitioners, I think what they should be striving for and kind of demanding is that, hey, this in fact is a powerful way of providing great outcomes for my clients. What I really want is commercial oriented software that enables me to leverage the power of these models. And so what is needed is that commercial software for the vast majority of practitioners.
And do you foresee that practitioners would, if I'm a financial advisor, I will collect a few very personal parameters, so to speak, when it comes to things like risk aversion, and you plug these in for the clients and find an outcome, knowing that they won't know exactly how the sausage is made in the program if they use it. How do we understand the output of a model where the parameters, such as like risk aversion, is quite hard to quantify? We get a sense, it's a high risk, low risk person.
Right. But that problem exists today, right? So almost all advisors, wealth managers are using something akin to a risk profiling, risk tolerance questionnaire. The person answers, questions. That questionnaire is scored, and then, the sausage is hiding behind the scenes. How do the responses get turned into, whether it's a numerical value or how do they get mapped to a portfolio? That's a mystery, probably to the advisor that's using the system and to the end user who's getting a portfolio. And I guess as we move into a world, almost defined by AI and outsourcing and, trusting in the model, I don't know how, the, Waze on my phone, picks the optimal way for me to travel, but I trust in it. And of course, I'm sure lots of people are competing in terms of how do you create the best navigation software. And again, the purpose of publishing, right, and to put this out there is to have it vetted by other, PhDs, other model builders, and again, eventually create systems and solutions that benefit investors. My belief is we're probably headed towards driverless cars here at some point in time. And, maybe some manufacturers will be better at creating safer driverless cars. But again, at some point in time, we will begin to trust in driverless cars. At the moment, I would be very skeptical of it, but I think we're willing to say, I trust in the doctor that's performing my surgery. I trust in, Excel that is coming up with these numbers. Again, the design of the book is to put it out there for those that really want to get into the details and understand how it's working. It's there. But there will be, again, I think, end users that are simply the beneficiary of very advanced techniques and analytics.
Have you tested out like how?
Also, it just out of our.
Go ahead.
Oh, I was just saying, I think just at a more fundamental level, the first question is like, what does it actually mean to give financial advice? Does it just mean putting together a portfolio of funds? Or, what more is there to it, and this framework says this, there's a lot more to it. You have to consider, the various preferences. You have to consider, person's human capital, and also, giving advice on how much they should, how much they should be spending each year, how much they should be saving each year, and so on. So I think that's the more fundamental question. What is financial advice? What does it consist of?
And I bet a lot of practitioner would, one pushback maybe you'll get is that financial advice is a lot of psychology. It's non-measurable senses of where a person wants to be going in life, and you're as much a psychologist as an actual financial planner when you have clients like these. And maybe that would be a reason they want to like get some like more control of the ultimate. Of course, they're always going to be in control. You can get an output from a model like this, and then you can do what you want with. You can be discretionary with it. But I guess that's kind of maybe where some people's head would go in terms of it's not
whether they're using our model or somebody else's model. Again, that that kind of communication between a financial planner, a financial advisor, and their client, that's critical. And again, how do you set the expectation? How do you begin that coaching process with your client from the get-go? Again, getting back to kind of, our approach and what we would advocate for is, that having a picture of somebody's net worth, having that economic balance sheet so that a client can understand the big picture, that's critical. And then again, we talked kind of about how Monte Carlo simulation is used to create, let's say kind of an up market scenario or a down market scenario of what that balance sheet might look like in the future and what we might do from an investing standpoint. If you've had those conversations up front with that client, my guess is that they're going to go much more smoothly than if you're having them in the middle of a down market for the first time.
Right. All those things. But back to just the qualitative kind of parameters such as individuals, risk aversion, and the like. Have you tested out, run the model, and seen like how sensitive is it to those kind of variables versus the more like the harder data? Like if you set me at risk tolerance of 7 rather than 5 on a scale from 0 to 10, like how much different is my portfolio and things like that?
But maybe there's some parameters where different people would, have a very different preference, and that would end up in a very different result. And maybe there's other parameters where it's maybe not as visible in terms of the output to the end user. But, so let's just say, risk preference or risk tolerance. There's some people that really are comfortable with risk, have a high degree of tolerance, would really prefer, an equity-centric portfolio, where conversely, others might have that preference, again, for a very conservative, very safe portfolio. And those extremes are very visible in the end portfolio to that investor. We talked a little bit about annuities, right? And bequest, and, kind of that desire for leaving the maximum amount to your heirs or to some sort of cause versus making sure that I can enjoy my standard of living, whether I live to 85 or 105, that matters. And so, where it would be visible is somebody purchasing annuities or not? And again, on the life insurance parameters, that again, you get to see whether somebody is or isn't buying life insurance. It's perhaps less visible if we're talking about the degree to which somebody wants to consume maybe a little bit more now and less later, or maybe vice versa, or how do they rate kind of smooth consumption, or they're willing to take less smooth consumption for the expectation that they'll have greater overall consumption. That's probably a little less visible to people. So some parameters have significant outputs or significant impact on the outputs, and others do not.
And as you mentioned before too, so this might be something that people apply, and financial advisor applies, and comes up therefore with the output, which is a specific portfolio for a specific client. And then you sit down and see, does this make sense? Is this what we want? You feel good about this allocation, right. And then they might discretionarily tweak it from there.
I would say sure. Again, I guess almost the premise of the question, though, again, I think is kind of where the industry is at. Let's focus on the portfolio. And I think what we're trying to say is that there will be a portfolio, and the portfolio is important. But that, again, I don't like to use this, I'm going to say, but it's of a second degree of importance. What really matters in terms of somebody's ultimate, lifetime success is the stuff that is coming from the life cycle model. Are you saving enough? What should you be consuming? What are the risks that you face, like some mortality risk or longevity risk? And are you hedging those appropriately? Those are the things that, as a financial planner, you really want to get those right. And again, whether you chose the best performing active or passive fund, or, this large cap manager over another large, that is just noise.
So maybe you would say that many financial planners are too focused just on the portfolio, and maybe only have a conversation about that without even bringing up the consumption part and all that saving part.
Right. So, what is wealth management? Well, I think as an industry, we've defined it as managing that portfolio, where in reality, financial planning or wealth management, in my mind, should be a combination of financial planning mixed with investment management. But that financial planning piece is ultimately the most important for that person's well-being.
Yeah. So the framework is very much, I think only about US based financial planners here. And because feels like it's written for that audience. How would you say, for the people listening who are not in the United States and want to implement this, there are several things that seems to be like the model will be very different if you are in different countries with different kind of tax structures and things like that.
Yeah.
Anything to say about that?
Yeah. Yes. The model would be identical. That it doesn't change, right? The jurisdiction, What would change based on jurisdiction would be the things related to taxes, or things related to retirement savings accounts and things like that. So the model doesn't change. The parameters that you set in the model would change.
No, exactly. No, that makes sense. All right.
So can I emphasize that really quick? You said the book is global, right? It works for financial planners, wealth managers around the world. There are nuances, related to tax and stuff like that. But again, the model as a whole is a global oriented wealth management model.
Yeah, excellent. Well, 4 long conversations about this book. I really hope our listeners have got a good view of what's in it. I'll give you both gentlemen a one more chance to give listeners and viewers here the reason to read the book and any other insights about what they should think about the framework really, and your thinking as a whole, kind of where you're coming from here.
I'll jump in, Paul, and then let you go. So big picture, just like what I was saying earlier, the financial planning piece, the life cycle piece, that's what we really need to get right. The investment management piece is important, but that's secondary relative to kind of financial planning and getting the big picture answers correct. And then again, via the CFA Research Foundation, homepage for the book, for those that are interested, Paul and I are doing a chapter by chapter book club, and one can access not only the free book, the full podcast series with you, Lotta, of the 4 sessions, or for those that really want to get into the weeds and really hear the details. Again, we're going chapter by chapter, and you can access those via the CFA Research Foundation webpage as well.
Yeah, that's excellent resource. We're going to put it on the homepage, but also I'll link it here below as you're listening to this on YouTube.
Yeah. I'll just add to that even within the investment management piece, we emphasize taking a holistic net worth approach. Human capital needs to be taken into account. Liabilities need to be taken into account. Asset location, across taxable and tax advantage accounts should be taken into account. So not all of the investment management which is done today probably has all those features in it, and so I think we even have some lessons on the investment management side as well.
Great, thank you. So maybe we can have one more glance at the book, so that when you click through, you're gonna recognize what it looks like. That's where it is. You're gonna find that on our homepage. It's linked below here in the conversation as well, whether you're listening to a podcast or watching the video. So that was our 4th conversation. Thank you so much, gentlemen. It's been a pleasure talking to you. And thank you, everybody at home. This was the Financial Thought Exchange podcast from the Research Foundation of the CFA Institute. If you like our content, please like this video, subscribe to our channel so that you don't miss other episodes. I've been Lotta Moberg, and thank you so much for tuning in.
For more information, please visit rpc.cfainstitute.org/research-foundation.